people who just going to view this for their benefit, if you could just share, is the
Right.
risk management the key for a successful trader?
Absolutely. I mean, you have to manage your capital. So we would say money management was just as important as pricing. So you would need to scale into your positions and size your trades based on your capital base. If you had unlimited funds, then you didn't have to worry about that so much. But that's not the case, particularly somebody who's starting out, and you need to be around the next day to trade. So the ability to allocate initial trades and scale into positions, and also cut losses appropriately so that you can learn from any mistakes that you made, and then regroup and do it again. Now, if you're successful in your first trades and you don't have that difficulty to worry about, that's one thing, but it's rare that occurs.
So coming to your point, I mean, which you just referred, I mean, that's position sizing, what you said, scaling in and scaling out. I think that was one of, that has always been actually one of your favorite ways to get into a position. I think you're known for not going and doing an upfront order all the time and just dipping your feet and just getting into the market, and then take a position when it's basically profitable.
Mm-hmm.
So is that the correct way, or your experience made you learn that way and you adopted that strategy? Because initially, I think I learned about you that initially there were mistakes which you made, which probably led to this kind of management of position sizing, because very, very important for a trader to have a position sizing in accordance with that.
Absolutely. Well, no, that's the case where I guess I was lucky to lose substantially early on. I mean, I almost lost all the trading capital I had in the first month or month and a half of my trading, and regrouped. And that scare that I got made me refocus even to a greater degree and try to hang on to what I had. And I learned from a couple old traders that were very disciplined themselves. And I think I've always said this, that being in a spread at a bad price is better than losing on a straight order and not having any position on at all. So if you start out with a portion of what you want to allocate in the strategy and it goes against you and you scale into it and you average your spread price, for instance, you're going to be better off than if you lean into it and
do an upfront order.
Yeah, do it all at once. Now, if you're not given an opportunity to get in at better prices, then that means it's working for you, and you can take advantage of that and look at the next strategy that you want to utilize. One other thing is that my style was to always have the next move determined. So if I was legging into a vertical and it went my way, there was going to be another vertical that I would sell against it to have a butterfly on, for instance, at a reduced cost or no cost or possibly even a credit, and then I would throw it in the spread hopper, as I would say, and forget about it. 10, 15, 20 years ago, you couldn't say that a retail user could do that very easily because commissions were such that it was very expensive. Today, both here and in the US, the commissions on options trading have been cut so much that that strategy, that type of trading is doable. And it's a remarkable situation where with a little momentum, you can put on spreads that you don't have to worry about.
So what it means is like if you miss an upfront order and you just scale in and you find the price, you're basically implying that if you even miss out on a price move, you got a next strategy in hand, so that the feeling of being left out is not there, and you already got the strategy, so that you don't chase the price.
Right.
So you mean it's advisable that somebody who wants to be an aspiring trader, he should, rather be, not chasing the prices, but just get into the position and with the strategy, and then, scale in and then scale out of the profits as he puts that strategy to use.
Right. Well, an option spread affords the trader multiple choices in exiting or changing the risk profile.
That's right.
If you're just trading futures or the underlying stocks, you have a pretty much a binary set of choices.
Absolutely.
So the optionality comes into the position, and you can change the risk characteristics quickly, and over time and with some experience, you can see that there are variations of risk that you can tolerate and have work for you.